Good day everyone, we are the group 4 and today we're going to tackle about derivative instruments. So this is Loremi C. Pacolba, your first reporter, and let's define first what is derivative means. So derivative is a financial instrument whose value is determined by or derived from the value of another asset. And the main uses of derivatives are the following.
First, using derivatives to hedge risk. Using derivatives for the objective of minimizing risk on the physical market.
So individuals or businesses uses derivatives in order for them to limit the risks in the physical market and give them as insurance policy.
Second, speculating on derivatives. Speculation on derivatives is motivated by profit rather than a desire to mitigate risk.
Individuals or businesses use derivatives directly driven by opportunity or profit. So here are the types of derivative instruments. We have short-term interest rate derivatives, swaps, options 1, options 2, options 3, and credit derivatives. So let's discuss first what is short-term interest rate derivatives. Short-term interest rate derivatives, its primary use is to hedge against interest rate exposure in short-term lending. The two main contracts used in short-term interest rate derivatives are forward rate agreement and short-term interest rate futures.
So forward rate agreement is an over-the-counter derivative instrument that trades as part of money markets. An FRA is essentially a forward starting loan dealt at a fixed rate but no exchange of cash principal. Only the interest applicable on the notional amount between the rate dealt and the actual rate prevailing at the time of settlement changes hand.
So an FRA is an over-the-counter agreement, which means it is traded directly between the counterparties or privately negotiated between the two parties.
FRA is an off-balance sheet instrument by trading today at an interest rate that is effective at some point in the future. FRAs enable the bank and corporate to hedge interest rate exposure.
When we say off-balance sheet, this is term for asset and liabilities that do not appear on company's balance sheet. Although this is not recorded on balance sheet, they still an asset and liabilities of companies.
An important thing about the FRA contract is that the users do not actually lend or borrow the amount. Instead, the interest rate in the FRA is compared with the ongoing LIBOR rate. If the FRA rate is more than the LIBOR rate, then the borrower has to pay the lender for the difference in the interest rate. And if the FRA rate is less than the LIBOR rate, then the borrower could effectively get money at less than the market rate. A point to note is that the payment eventually compensates only for the changes in the interest rate after the contract date. There is no involvement of the principal amount. For example, a commercial bank plans to come up with CDs or certificate of deposit. The bank, however, expects the rate to go up. So to minimize the risk, it can lock the current rate by entering into a forward rate agreement. In case the interest rate does rise, then the bank would get the payment through FRA that compensates for the higher interest. Forward contracts is an OTC instrument with terms set for delivery of an underlying asset at some point in the future. Forward contract fixes the price and the conditions now for an asset that will be delivered in the future. So a forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. Example, a farmer expecting to harvest his corn crop in 4 months. He is concerned that the price of a corn in 4 months might fall below the level it is at today. So he can enter into a forward contract today for the delivery when the crop is harvested. However, the price the farmer received will have been agreed today. So whatever happened in the price of corn in 4 months, the price is fixed based on their agreement. Short-term interest rate futures. The future contract is a transaction that fixes the price today for the commodity that will be delivered at some point in the future. These contracts are standardized and traded on exchanges. So future and forward contracts are similar in terms of the following. First, both are agreements to buy or sell something in the future. Second, allowing both sides of the trade to lock down the prices. And lastly, both help to mitigate risk and losses of price fluctuation. The future contract is safer than forward contracts because it is standardized and the transaction involves clearinghouse, which reduces the risk the one of the two parties involved will default.
Hello, I am Maria Jella Remolia Caceres, a third-year BSB student at North Vice campus. For today's video, I am going to discuss about swaps. Swaps are one of the most important and useful instruments in the debt capital markets. They are used by a wide range of institutions, including banks, mortgages banks and building societies, corporates, and local authorities. Swap is a derivative contract through which two parties exchange the cash flows or liabilities from two different financial instruments. Interest rate swap are one of the most important type of swap in terms of volume of transactions. They are used to manage and hedge interest rate risk and exposure, while market makers will take positions in swap that reflects their view on the directions of interest rates. In the interest rate swap, the parties exchange cash flows based on the notional principal amount, which is the amount is not actually exchanged in order to hedge against interest rate risk or to speculate. An interest rate swap is an agreement between two counterparties to make periodic interest payments to one another during the life of a swap on a predetermined set of dates based on a notional principal amount. The other party is the fixed rate payer, which is it is agreed at the time of the trade of swap. Then the other party is the floating rate payer, where it is being determined during the life of the swap. For example, a certain company may have a bond that pays the London Interbank offered rate or on the LIBOR, while the other party holds a bond that provides a fix of 5%. Swap spread is the difference between the swap rate, or the rate of a fixed leg of a swap, and the yield of the government bond with a similar maturity. A swap spread, this is the difference between the fixed component of a given swap and the yield on the sovereign debt instruments with a similar maturity. For example, ABC Corp enters into an interest rate swap with XYZ Corp, a 3-year interest rate swap in which ABC Corp or the payer must pay a 3% fixed interest rate, while XYZ Corp, which is the receiver, must pay the floating interest rate that equals 1-year LIBOR. Constant maturity swap is a swap in which the parties exchange a LIBOR rate for a fixed swap rate. This is also the variation of the regular interest rate swap, in which the floating portion of the swap is reset periodically against the rate of a fixed maturity instrument. Basis swap. In a basis swap, both legs are floating rate but linked to different money markets indices. A basis swap is a type of swap agreement in which parties agree to swap variable interest rates based on different money market reference rates. The goal of the basis swap is for a company to limit the interest rate risk it faces, as well as a result of having different lending and borrowing rates. Differential swap is a basis swap but with one of the legs calculated in a different currency. A differential swap allows a company to take a position linked to an interest rate index denominated in a currency that differs from the currency of the loan or deposit without running exchange rate risk. Forward start swap is one of the effective date is not usual 1 or 2 days after the trade date but a considerable time afterwards, for instance, say 6 months after the trade date. A forward start swap, also called deferred or delayed start swap, is an agreement between two parties to exchange cash flows or assets on a fixed date in the future. Swaption is the right to enter into a swap agreement at some point in the future during the life of the option. A swaption is an option to exchange a fixed rate bond cash flow for a floating rate bond cash flow structure. It's granting its owner the right but not the obligation to enter into an underlying swap or into the predetermined swap contract. Asset-linked swap are created when the swap is linked to an asset such as a bond in order to change the characteristics of income stream for investors. This is also a derivative contract between two parties that swap fixed and floating assets. The transactions are done over the counter based on the amount and terms agreed upon by both sides of the transactions. Liability-linked swap are traded when borrowers of funds wish to change the pattern of their cash flows. A liability-linked swap is an interest rate swap or currency swap to change the interest rate exposure or the currency exposure of a borrower.
Alright guys, good day. I'm going to report options 1 and options 2. Options 1. An option is a contract in which the buyer has the right but not the obligation to buy or sell an underlying asset at a predetermined price during a specific period of time. So, what is option? Options are a form of derivative financial instrument in which two parties contractually agree to transact an asset at specified price before a future date. So, options guys, gatalk niya siya about sa buyer and a seller which having their contract. Then, derivative financial instrument guys, meaning ano niya kay financial instrument that derives their value of response to change in interest rate, financial instrument prices, commodity prices, foreign exchange rate, credit risk, and indices. Options terminology. There are three types of options terminology: call, put, and strike price. So, calls, the right but not the obligation to buy a specific number of shares of the underlying security at a defined price until the expiration date. Then put, the right but not the obligation to sell a specific number of shares of the underlying security at a defined price until the expiration date. So, the difference between call and put, guys, kay si call, siya ang to buy or mopalit. Then si put, kay siya may to sell or mobaligya. Then si strike price is the price at which options holder can exercise their rights. Two types of option: American style and European style. So, American style, an option that can be exercised at any time before expiration. So, sa American style, mabuhat or ma-exercise siya at any time before the expiration. Sa European style, an option that can be exercised only at expirations. Note, so sa European style guys, ma-exercise na siya at the expiration. So, usapan mo siya sa ilang style at the expiration na siya ma-exercise. So, the other type of option is Bermudan style premium. So, excuse me, Bermudan option are different from both American and European's option. The contract for a Bermudan style option denotes a specific days before expiration on which the trader can exercise his options. So, kani siya guys sa Bermudan, specific days before expiration can be exercised. So, is na siya specific days yun or date nga ma-exercise. So, the next topic is option instruments. So, options are traded both on recognized exchange and in the OTC market. The primary difference between the two types of the exchange-traded options are standardized contracts and essentially plain vanilla instruments, while OTC options can take on virtually any shape or form. So guys, meaning sa OTC is kanang over the counter. Exchange traded options available on the following. So ordinary shares, options on future, stock index options, bond options, interest rate options, and foreign currency options. So ordinary shares, guys, is also called common shares. Ordinary shares are stocks sold on a public exchange. Options on future. So options on future are contract that represents the right, not the obligation, to either buy or sell a particular underlying futures contract at a specified price on or before a specified date. The third one is stock index options. So what is stock index options? Stock index options is a financial derivative that gives the holder the right to buy or sell the value of an underlying index, such as the S&P 500 index at the stated exercise price. So the fourth one, guys, is bond options. Bond options is a contract in which the underlying asset is a bond. Like all standard options contract, an investor can take many speculative positions through either bond call or bond put options. The fifth one is interest rate options. Interest rate options is a financial derivative that allows the holder to benefit from change in interest rates. And the last one, guys, is foreign currency option. Foreign currency option is a contract giving the option purchaser or the buyer the right but not the obligation to buy or sell a fixed amount of foreign exchange at a fixed price per unit of specified time period. Then the next topic is all about bonds in option pricing. So the upper and the lower limit of the price of an option are relatively straightforward to set because prices must follow the rule of the no arbitrage pricing. A call option grants the buyer the right to buy a specified quantity of the underlying asset at the level of the strike price. So therefore, it is clear that the option could not have the higher value than the underlying asset itself. Therefore, the upper limit or bound to the price of a call option is the price of the underlying asset.